We used our dividend-paying whole life insurance policy to purchase an investment property in Dominican Republic. My name is Darius.
And I'm Carmen. Say what now? Yep, exactly. We're going to go through those details today. But the main thing is understanding the concepts in which we're talking about. We go into all of these details inside the Money School. So if you want to know more about how we do these things, then definitely click on the link below.
Right. What we want to discuss with you is how we got there. How we got to purchasing our property in Dominican Republic from where we started with $120,000 worth of credit card debt.
Yep. And that you can click on that video here because we show you how we do that on the screen.
Right. So what I want to start with is the mindset shift that happened when we were paying ourselves back the minimum payments that we would have paid to the credit card company. Mm-hmm. Because what we did is we basically went to the banks or the credit card companies and said that we're going to take over these debts ourselves. So if you ever, when you had a mortgage payment, saw that, hey, Wells Fargo is no longer going to be the financer on your mortgage, is going to go over to Chase. Mm-hmm. This is exactly what we did when it came to our credit card debts. The only difference is we used our whole life insurance policies to do the exact same thing. Mm-hmm. So what that meant is that our minimum payments we were still paying. The only difference is we weren't paying them to the financial institutions. We were paying them back to ourselves.
Absolutely.
Now, the switch that happened here for us is the fact that we were able to see the volume of interest that we were paying. There's a difference between paying it to the
someone else,
to the credit card company, and it being split across 10 different credit cards that we have versus seeing all those minimum payments come back to us in one place. Mm-hmm. That money started to accumulate at a very high rate.
Yeah. And I mean, to put things into perspective, at some point during our journey of paying off our debt, we were paying $2,000 a month in debt payments and not thinking anything of it because it was $100 here, $50 here, $200 here. But when we added it up, we're like, holy cow, this is a lot of money that we're spending every single month. And how can we take that over and start paying ourselves? Mm-hmm. So as that money started coming over to our ownership, we recognized how much more of our income we were able to keep because we were just sending it to the banks. And don't get me wrong, not all of this came over at once, right? We had to take over one debt at a time. But as we started to Red Rover, bring this debt over, we recognized that was good. I like that one. Yeah, we recognized that, hey, we can start capitalizing and maximizing our income more than we ever knew that we could.
Right. We basically did a snowball into our own account.
For real. That's exactly what happened. Now, folks, again, we are talking about savings. We are talking about checkings account. We're talking about paying off our debt. In no way, shape, or form are we talking about investing. I feel like a lot of times people can confuse this concept with investing, and we're simply just talking about banking functions. That's it.
Yeah. So the banking function we took over was the credit card debts that we had, and we had a significant amount. Another thing is the fact that we had $120,000 worth of debt. That was just the principal. What we didn't realize until we started paying ourselves back, like I said, is that it was more than $120,000 that we actually have in our account now. Mm-hmm. And what we started to do is, at the time, we just had our daughter. Yeah. And what we needed is another vehicle. Mm-hmm. Now, the nice thing about the fact that instead of us paying those credit card debts and instead of paying the bank and start paying ourselves is the fact that we have access to that cash to do something else with. And at the time, we needed a car so that we can take our daughter to and from her doctor's appointments. Mm-hmm. So we purchased this car for about $42,000. We used our life insurance policy the same way we would if we were to finance it from a bank. Mm-hmm. So the conversation we had with the finance company at the car dealership is, if we had mid-level to low credit score, what type of interest would we be able to get on this car? Mm-hmm. Well, he said about 8%. So because we are able to control that function, what we are able to do is decide how much interest we decide to pay back ourselves.
Totally.
So what we did is we decided to pay ourselves back 10% interest on the car purchase.
Mm-hmm. We assumed, right, ourselves to be less, have a subpar credit score in our own banking system. Mm-hmm. Because if we look at the banks and say, hey, they're going to charge upwards of 6, 7, sometimes 8% on card notes, why don't we charge ourselves the same thing? Because at the same time, it's just coming back to us. Right. So it doesn't matter what our credit score is. We just said, hey, what is the bank charging for, a 650 credit score, whatever it is. We're going to do the same thing because, again, we're controlling these functions.
Right.
And one thing I just want to interject real quick is when you control the banking functions in your life, you really start to look at money differently. And I want to make this point because what Darius was just talking about is a $42,000 car. We, at the time, when we were making this decision, we had access to over 6 figures worth of funds that we could use to dedicate to this car. But because we control the banking functions in our lives, we weren't looking at spending the whole pool. We said, hey, how can we be as strategic as possible? We just need a car that's going to get us to and from, because at the time we were living in a city, we didn't own a car. We moved out to the suburbs, we needed a car. So we said, okay, what are we going to do? And when we looked at how much money we had to access, we said, wait, we want much more of the income going to investments and other things that are going to make money, and we're going to spend so much money on our car. And the reason why I'm making this point is because how many times as consumers do we spend up to the last penny we got on a car, on a vehicle, or whatever it is? The bank says your minimum payment is, you qualify for $500. How many of us pay $520? Because we were there, right? How many of us push it? Maybe $560. I think we can squeeze it here or there. But I'm sharing this with you because once you have access to capital, you look at things differently and you make transactions differently. So I just wanted to put that out there. And the other thing too is we had to look, every time we look at an opportunity, it's how can we turn a liability into an asset? When a car note for us, using from a third party standpoint, that's a liability because we're spending that money and it's not coming back to us. But we had to flip the car literally and make it become an asset. How can we buy it and turn it into an asset where we're making money from it? And that's where, when you start to think about creative financing, that's how these opportunities come to you.
Right. And again, I go back to mindset shift, because how we were thinking when we initially started our system, when we were paying off our credit card debt, is different when we actually purchased a car.
Yes.
Reason being is because we were able to decide the interest rate, and for us, we realized at that time that it's important for us to pay the higher interest rate than we normally would. Yeah. Reason being is because we have those funds to
available
to deploy again. And how we deployed the funds after we purchased our cars, because the money, of course, the volume of interest, it accumulated faster than the cost of us borrowing the money, is we purchased 2 mobile homes. Now, but
remember, folks, we started with our life insurance. Our life insurance is buying our property in DR. We're going to get to that. Yeah. We're just showing you the roadmap in which we took in order to continue to make more and more investments, more expensive investments, because of the accumulation of cash that was coming our way.
Right. So we still have to pay for this car until 2025, but yet we already used those funds to buy
the minimum
2 mobile
payments.
homes.
Yeah.
Now
the minimum payments that we're accumulating, we said, okay, what are we going to do with this money? Let's move it. Let's move money to make more money. And so that's when other investments came about.
Right. Now those 2 mobile homes also cost $45,000. So if we borrow $45,000 to buy a car in less than 2 years, which we borrowed the car, we decided to pay ourselves at a 60-month rate, because that's what you mostly do. That's very popular, 60 months. Before that contract is up, we've already deployed the money to buy a $45,000 investment, which is 2 mobile homes. We're able to do that because, again, it goes back to the volume of interest that you're able to pay yourself when you realize that you're paying it.
Yes.
If we were to finance this car traditionally, we wouldn't have seen those payments. It wouldn't have hit us differently in our gut on the amount of interest that we're paying away from ourselves. Yeah. So again, we bought these 2 mobile homes. Now these 2 mobile homes are paying us 12% interest on the $45,000 loan. One loan is going to be done in 2024. The next loan is going to be done in 2028.
Yeah.
So
now, just with 3 transactions, how much interest are we bringing back to ourselves with the car?
The car is 10, and then 12, and 12.
Exactly. So now, in addition to the compounding that we're already receiving from our whole life insurance policies, we're stacking interest rates on top of interest rates, and you see how this whole thing can start to accumulate.
Right. So we got a 10, a 12, and a 12. That's about 34% interest on top of the
4%.
On top of what we're guaranteed in the interest rate. And on top of that, don't forget the volume of interest that we're also able to accumulate throughout this process.
Absolutely.
So next, what we decided to do with those funds, we're receiving monthly payments from the mobile homes, and we're paying monthly payments from our car note, and we're still paying ourselves first to make sure that we maintain our premium payment. Yeah. So all this is growing our system. So what we decided to do is purchase an investment property in Dominican Republic. Now, Dominican Republic is a place that's near and dear to our heart for us personally, because Carmen and I live there, and this is a place that we want to go back to at some point. So it makes sense for us to invest in a property in this country.
Yeah, exactly. And again, it goes back to that lifestyle ownership. We've talked about this on many videos, where this is something that Darius and I have dreamed about doing, and we always put it on a vision board, and it seemed like a lofty goal, and then all of a sudden it became available, and we're like, oh shoot, be careful what you ask for, right? Because it came knocking, and we were like, time to put your big girl panties on and make this happen. So with this opportunity, it just came about recognizing, again, the volume of interest that is all coming back to us because of how we decide to finance things differently. Now, again, if you want to see these details and the numerical breakdowns, we reserve all of that information for our students inside the Money School, and it's important that we share all of these things with you. So again, we want to make sure that you guys understand we are calculating all of the fees that the insurance companies dock into here. We're talking about the dividends, everything that flows in and out of our banking systems. This is all accumulated into everything that we're doing, and this is still lucrative, and it still makes sense for us by utilizing the maximization that we can do with our savings accounts, right? We literally just showed you how we take our savings accounts to invest, right? So when we think about things differently, it's just amazing what you can do using products differently than maybe mainstream media may tell you how to do so.
Right. And different for us is just seeing the accumulation of the interest. I keep going back to that because that significantly changed the way I thought about banking, the verb banking, or the action of banking versus financing things through somebody else, or financing things through the bank itself.
Absolutely. And now with this property in DR, it's still under construction as of the day of making this video. It's going to be available for rent, and that's going to be another investment property that we're going to be making interest on. That's going to allow us to continue to compound and buy more investment properties all over the world. Hopefully that's also on our vision board. So we want to make sure that you guys, again, understand the concepts, understand the nuances. We're not intentionally trying to leave stuff out for you. We just want you to understand the ways in which we're doing things. And again, if you want those details, then join the Money School. And one thing I want to leave you all with is, as Darius was talking through this whole process, I was just sitting back and listening and recognizing, like, when we first started our banking systems, we were literally just trying to get out of debt. And I had no idea or any wish that we were going to be able to do more, because we were just so focused on getting out of debt. And as these payments started coming back, and as we really started to understand banking and compounding interest rates and stacking interest rates, it blew our mind as far as what we could be doing with our income. And it's really important for you all. I hope that you can start to understand these concepts through our videos. Is if you can control more of your income, what will that do for you? Because as opposed to us, we were so used to spending our income and not seeing anything after 12 months. But when you start controlling more and more of your income and holding on to it and investing more and more of that income, it's amazing what you can do with just $50,000 or even $100,000. And once we started to see that, we said, wow, if we make $100,000 this year, for example, can we keep 70% of that? Because before we may have kept 10%, right, if that. What happens when you start building and just saving 10, 20, 30, 40, just saving more and more of your income to allow you to do more? That's going to open up the doors for you as far as investing. That's going to change everything that you can do. And it just starts with controlling your income. And I feel as consumers, we don't know that or understand that because we're so used to paying somebody else.
Right. We're so used to seeing the money go away from us. But when we sat back and started to realize that 70% of our income was going to finance things that we finance through a bank, and we can control those, then it becomes more realistic to realize that you can control 70% of your income by financing things through your own system.
Yeah. And we're not even talking about like just the savings, right? We talk about paying yourself first. We're talking about all the money that you're paying out. How can you be more strategic with those funds in addition to the savings that you have, in addition to the money you're contributing to retirement? How can you maximize your efforts every which way that you're going so that you can keep more of your income? And that's what we hope to express and share with you on the Wealth Nation channel, is just how can we be more creative? How can we continue to push the envelope How can we own our lifestyle in so many different ways? Because at the end of the day, we are talking about money, but we're not talking about money, right? We're talking about the process, but what does this ultimately do for us? This creates so much freedom, so much ability for us to actually start doing the things that we want to do, like living in the Dominican Republic, having property there. And again, it's not about the money. It's just about the lifestyle that we require and the actions that we're taking in order to get there.
Right. And again, you mentioned earlier that a lot of people think that you invest in life insurance.
No,
we're not talking about investing in life insurance. We're talking about using our cash that accumulate in our life insurance policy to finance the things that we normally finance anyway. Because think about what the banks refer to us as. I think the banks refer to us as an investment, because what happened is you give us a little money and then we pay you back the money plus interest. Mm-hmm. So we're the investment for the bank.
Yeah,
so,
it's like having a rental property without the property.
Right. So if we're an investment,
they're Uber drivers without having cars.
Right. So if we're the investment, that means that we have the biggest impact on the finances that the banks are able to earn. So if that's the case, then we should start taking responsibility and doing those actions for ourselves. Now, again, it takes responsibility, it takes good habits to do this, and it takes discipline. Mm-hmm. So if you don't have those three things, then this isn't the best thing for you, because with great responsibility, or what's the Spider-Man thing? With great power comes great responsibility. And you can really mess yourself up by not having not being disciplined and not being responsible and not having good habits before starting this process.
Mm-hmm. That's a really good point. And in addition to everything that Darius just said, now we have multiple policies, and multiple policies means more and more death benefit that we can leave for our family. Mm-hmm. And we are never doing this for the death benefit. It's just a perk that happens to come with this. And not only are we teaching this concept to our family, but it's going to reap several rewards for them should we ever need to use a death benefit. And the other concept that we want you to really understand is that if you're using life insurance and just putting it on a shelf and using it for the death benefit, then you're using it incorrectly, because the ultra wealthy use these concepts, use these tools differently, and you should start learning how to use them too in your benefit.
Right. So if you want more information on how infinite banking works, then check out our next video where we talk about that exact topic.
And don't forget to own your own lifestyle.
Or somebody else will.